This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and thank you so much for joining us on Money Talk on this rainy but very exciting tennis weekend. Here's a rundown of today's show. We start off with Dave Sally of the Ottawa Business Journal. Then we go to Vijay Settler, who is a sports marketing instructor at the Schulich School of Business. Then to Roger McKnight, who's Chief Petroleum Analyst at Enpro International. He'll comment on gasoline prices over the summer. And after that, my weekly talk with Matt Hendricks, who's Senior Vice President of National Sales at Sprott Asset Management. After the news, we go to Paul Wong, who is the manager of the Sprott Gold and Precious Minerals Fund. And then we conclude our show today with David Prince, founder and president, Harbinger Capital Markets Research. But first, to Dave Sally of the Ottawa Business Journal. Well, folks, it's that time again. I am joined by Dave Sally, who is with the Ottawa Business Journal, and we're going to take a look at the news of the past week. How are you, Dave?
I'm not too bad at all, John. How are you?
Great, thanks. Dave, this past week, a private consortium proposed a new passenger railway for the Ottawa region, while Mitel pulled out of its $2 billion plan to acquire a California tech firm, and the business community mourned the passing of a well-known entrepreneur.
That's right, John. Well, let's start with the private sector group's plan to launch a new passenger railway line in the Ottawa region. The group, called the MOOSE, or Mobility Ottawa-Outaouais Systems and Enterprises Consortium, applied for approval from the Canadian Transportation Agency to move forward with its plan in late June. The plan would use 3-coach, double-decker, diesel-electric hybrid passenger trains and would provide hourly service every day throughout Ottawa and Gatineau. It would also serve 6 rural towns, including Smiths Falls and Arnprior. And now the train would run on existing Via rail tracks and connect with Ottawa's light rail service at Bayview Station in LeBreton Flats, as well as with Via tracks at the Tremblay Road Station. The group says the plan would require no government money. Its financing model calls for the railway service to be funded largely through commercial and residential development at and around the train stations. The group hopes to obtain approval from the Canadian Transportation Agency within the next 3 months. After that, it would begin negotiations with the railway owners, including Via, as well as the various municipalities that it would serve. And the group says that if everything goes as planned, it could start moving passengers as soon as next July.
Well, that sounds like the GO train in Toronto. It's a very exciting development.
Yes, absolutely.
Now, there was big news this week out of Mitel.
Yeah, absolutely, John. As you may remember, Mitel back in April proposed a friendly takeover of California-based Polycom, but that deal has now been called off after Ottawa-based Mitel decided it wouldn't match a rival offer for Polycom. The two companies say Mitel will receive a $60 million U.S. termination fee from Polycom under the agreement announced in April. At that time, Mitel's proposed takeover was valued at nearly $2 billion U.S. in cash and stock. However, since then, Mitel shares have dropped, and the offer's value has subsequently fallen to about $11 U.S. per Polycom share from about $13.70 on April 15th. So instead, Polycom has decided to support a rival takeover offer from Cirrus Capital Group, LLC, and that offer is valued at about $2 billion U.S., or roughly 13.6% above the recent value of Mitel's bid. Now, had Mitel's bid gone through, it would have created a company with 7,700 employees and $2.5 billion in annual revenues. But on Friday, Mitel CEO Rich McBee said it simply would not be in the best interest of the company's shareholders to match the new offer. And he said that while he was disappointed the deal with Polycom won't go ahead, he doesn't expect it to have a negative impact on Mitel's bottom line.
And there was some sad news this week in the local business scene.
Yes, absolutely, John. The Ottawa business community bid a fond farewell this week to Leonard Lee, the founder of Lee Valley Tools. Mr. Lee passed away on Thursday morning at the age of 77. He was actually born in Saskatchewan and later attended Royal Military College in Kingston and Royal Roads College in Victoria, and he also earned a degree in economics from Queen's. Then he went on to a career in the civil service, but he found he was getting kind of bored with his job, and so in 1978 he launched Lee Valley Tools. After he couldn't find the tools he needed for one of his favorite pastimes, woodworking, so he decided to start supplying them himself and realized that other people were in the same situation. And eventually the company grew into a chain with stores across the country and annual sales of more than $100 million. Now, Mr. Lee was a serial entrepreneur. He eventually launched a medical tool company called Kanika Design and even started his own publishing firm called Oligrove Publishing, among other enterprises. He was named to the Order of Canada in 2003, and he received honorary degrees from a number of institutions, including Carleton University and the University of Ottawa.
He was an amazing guy, and there were some wonderful letters that were published, I believe, between Leonard and his customers around the world, and some of them are very funny.
Well, I can imagine just from the reaction of the business community and his family, he seemed like quite a guy. I unfortunately never got to meet him, but he was certainly a giant in the business community here in Ottawa.
And Dave, what's on the OBJ radar for the coming week?
Well, John, this one's for all you managers out there. The Code Factory, that's at 100 Gloucester Street downtown, is offering a workshop this Friday called Innovation for Managers. Innovation is a big buzzword these days, and so all you managers can go down and find out just how you can think more innovatively and try and incorporate innovation into the workplace. So that's coming up this Friday at 9 a.m. at the Code Factory. And for more information, log on to eventbrite.ca.
Well, Dave, thanks for bringing us up to date on the Ottawa scene, and we will talk again at 2 p.m. next Sunday. Take care.
You too, John. Thanks a lot.
Now to a timely interview with Vijay Settler, sports marketing instructor at the Schulich School of Business, York University.
History was made at Wimbledon for Canada. Milos Raonic has become the first Canadian to make it to a Grand Slam men's singles final. He did so by defeating Roger Federer in 5 sets in the semifinals at Wimbledon. So let's talk about what all of this might mean for the Thornhill, Ontario native and for tennis in Canada. Joining us now from India is Vijay Settler, a sports marketing professor at the Schulich School of Business. Vijay, great to be with you today. Thanks so much for joining us from far away. Let me get your reaction to this history-making day for Canadian tennis players.
No, absolutely. It's a great day for Canadian tennis. It's a great day for Milos Raonic, and for him to be able to pull off this achievement, although it's not the championship yet, but just to be able to get to the Wimbledon final is a tremendous feat, and his star is really on the verge of rising if he can pull off on Sunday.
Absolutely. If he can pull it off on Sunday, still it's a huge achievement so far. What will this mean for his marketing appeal for companies right now? He's already been having so much success, but what now?
Well, absolutely. I mean, he has a steady roster of brand partners that will only grow if he wins on Sunday. He has the likes of Rolex and Canada Goose and New Balance, and those brands will definitely benefit if Raonic wins on Sunday, because those brands will essentially have their brands take a bit of a spike because of the success that Raonic will have on the court by association. So it's a win-win for everyone associated with him if he wins on Sunday.
Let's talk a little bit about his appeal in terms of being Canadian and also squeaky clean. What are corporations looking for today?
Well, the thing that brands are looking for is an opportunity to align themselves with a property, and a property in this case being either a team or an athlete that's successful. Success has to be the main ingredient. Without that, a brand won't be interested. So if an athlete or a team is successful, then brands become interested. And as long as an athlete maintains qualities such as strength, perseverance, humility, passion, determination, those are all great qualities that brands want to then have people think that they're all about. So by these athletes maintaining those qualities and succeeding as well, brands will be interested, and the athlete's endorsement potential will only increase.
From this point right now, what can he command? And it's not even, I don't think it's just about the money, although people might disagree, but I'm just wondering, given his stature, ask for and negotiate more collaboration, more other items, I suppose, that maybe previous athletes have not been able to get from corporations. What's that looking like today?
Well, he'll probably be able to fill out his roster of brand partners in other categories that he's currently not representing. So perhaps something in the line of health and wellness, or perhaps in the automobile category. So different industry sectors are fair game for him to add to his stable of partners. So he's got a few right now. He'll be able to add a few more. And again, success will enable him to do that. He's not the most flamboyant of personalities on the ATP Tour, but if he continues to succeed and win the Grand Slam tournaments, which is really what it's all about, not just winning the ATP smaller events, but the actual Grand Slams, and that's when brands will really take notice. Unfortunately, the fact that he's Canadian is a bit of a strike against him, because American brands or brands based in the U.S. won't be as interested. But he'll definitely garner interest from Canadian brands if he keeps going this way.
Vijay, great to speak with you today. Thanks very much for joining us.
Thanks a lot. It was my pleasure. Take care.
Thank you.
Okay, folks, after the break, Roger McKnight, Chief Petroleum Analyst at Enpro International, taking a look at gasoline prices. And then my chat with Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Here for a weekly look at gasoline prices across Canada. Roger McKnight, Chief Petroleum Analyst at Enpro International, joins us on the line from Burlington, Ontario. Roger, happy Friday.
Happy Friday to you, Andrew.
So yeah, it's a paradox, isn't it? We're into peak driving season, but we're awash in gasoline, particularly in the eastern coast of America.
That's right. What happened is, if we go back a few months, back in November and December, the refiners were shocked to see that the demand was quite high, and their margins were just delightful. So they continued to make gasoline right into to building up those inventories, because the crack spread was there, the refining margin. Well, they built the inventories so high that now that they have a glut situation. So at this time of year, normally prices start to creep back up because, as you said, it's a peak driving season. Everybody's on the road. But in fact, what's happening is prices are actually dropping because they're trying to work through this glut. And this is going to continue on until such time as 1 or 2 or 3 or 4 refiners say, look, our refining margin is 50% below what it was this time last year. We got shareholders, we better do something about it. And the only way they can get prices or crack spreads back up is to slow down on production. In other words, start shutting down some refineries.
Walk us through prices across the nation. Where are they at their lowest right now, Roger?
At the lowest in good old Halifax. This is because their tax structure is okay, but they're also they do price controls basically through the government, and it's based on New York Harbor. And that's where the problem is, because there's a glut in what we call Pad 1, which is the East Coast, which controls really all pricing east of the Mississippi in the States and in eastern Canada as well. So Toronto and Montreal and Halifax are going to see some pretty hefty drops, with the Toronto market getting below the magical dollar level. In Western Canada, they're not going down as much because they're really following the crude drops, which aren't as significant as the wholesale or rack prices of gasoline, which is why we have the refining margin problem. So the drops there will be a little bit less. In Vancouver, they're going to get a break. Things have been falling quite steadily during the week, so the refineries in the U.S. Northwest are coming back on stream. So that's the situation as I see it. So it's good news, but I don't know how much longer this can go on.
And tell us, what about the actual demand for gasoline? In the States, it's very strong. Have you any numbers for Canada? I mean, is gasoline demand decent in this country right now as a whole?
We don't report. Nobody really reports anything like that. Nobody reports the inventories of gasoline, diesel, or crude oil in this country. So without the States, we wouldn't have the faintest idea what's going on. But demand in the U.S. has been positive in and around the 3 to 4% range since November. So it's still there.
Roger, always great talking to you. Thanks very much indeed.
You're welcome, Andrew.
Roger McKnight of Enpro International.
Now to Matt Hendricks. Well, it's great to have Matt Hendricks joining me today on Money Talk. Matt, I understand you're at a cottage, and it's good of you to tune in, as they say.
Well, for sure, John. It's not the best of weekends, but hey, anytime you can get away to the cottage, I'll take it.
Well, the precious metals markets continue to roll. We've seen gold, bullion, gold shares, silver bullion, silver shares up. And this week I interviewed Paul Wong, who's the manager of the Sprott Gold and Precious Minerals Fund and also the manager of the Sprott Hedge Fund. And this is a must listen, and it will be following our talk. But the gold shares came down during this horrible bear market that we experienced during the past 5 years by, in some instances, 90%. And they have rallied by about 100%. Paul Wong's Sprott Gold and Precious Minerals Fund is up, I believe, 108% as at Thursday evening.
Well, John, as of market end Friday, his fund is up 130%. That's 130. And our silver equities fund is up 150%. Year to date. That's in 6 months. So yes, these shares have definitely been roaring back. And when you consider the fact that the underlying bullion in the gold's case, I believe, is up around 20%, you can see the leverage. I mean, Eric Sprott always talked about owning the miners versus the bullion and the leverage you get. And we are experiencing now, as you say, after that 10-year bull run between 2000 and 2010, I mean, we had a very, very long and deep washout in the precious metals market, but we are back in a bull market. It is glaring us in the face, and we really want our listeners to get a sleeve of precious metals in their portfolio, and the Paul Wong interview is a great one.
And the fact that the shares have had this rally is probably frightening people. They say, oh, well, the whole move has taken place. But I went through the bull market in the 1970s, and we saw what happened between 2002 and 2011, and this market, as they say, looks like it has legs, and that's both in gold and silver, and there are a number of very good vehicles. You might just, for our listeners, tell them about the ways that they can use the Sprott precious metals vehicles for their portfolios.
Well, sure, John, and just going back to your point, so if you had $100 in precious metals, let's say at the end of 2011, it went down to basically $10 in early 15. So that was a 90% drop. So as you say, if you double off of that bottom, you're still only back up to $20, which means you're still 80% down on your investment. So that's where we are now. So there is lots and lots of room left in this bull market, we believe. And yes, so you can play the Gold and Precious Minerals Fund, run by Paul Wong, is about 80% gold shares and 20% silver shares. And he's got a mix of small, mid, and large caps. And then our Silver Equities Class Fund, which is the only fund in Canada completely dedicated to silver stocks. There's not too many silver stocks in the world, believe it or not, pure silver plays. And we basically almost own them all. And they're flying 150% year to date, net of all fees. And so those are two great ways to add leverage to your portfolio. And again, you want to have an idea of what your risk level is in your portfolio and add precious metal sleeve accordingly.
And the point of this is that if you get those sort of gains with 10% of your portfolio going up, say 100% in value, that means that adds 10% to the overall portfolio.
For sure, John, and that really is making a difference this year because core equities are really having a struggle here. I mean, the Canadian market is doing okay because it's being led by precious metals and energy, but you know, again, with all this strife of Brexit and all this a week and a half ago, I mean, the markets have come roaring back, but still on a year-to-date basis, the gains in the equities are not that well, and global equities are down, bonds are having a struggling time, and so to have at least a part of your portfolio is up, I mean, it's a nice thing to have, and that's certainly what the precious metals are doing right now to our clients' portfolios.
You might just mention the other core holdings because they are the stabilizers together with these alternative strategies around the perimeter of the portfolio. It allows people to sleep at night, and I always mention that people should talk to their investment advisor and ask their advisor about the Sprott funds.
For sure, John. I mean, John Wilson in our Enhanced Equity Class Fund That is your core North American equity. We've got Dennis Mitchell with our focused global strategies for dividends. We've got our diversified bond class fund, Scott Coburn running some fixed income. And again, we layer that with our really unique alternative income strategies, which not too many companies have out there, that are really adding some serious value to our clients' portfolios. And then, as you say, for the octane or the alpha, you've got your energy and your gold, which really rounds out a portfolio.
Now, did you mention Eric Nuttall's energy fund?
Yes, Eric is up over 40% year to date, and he is number one in Canada on a 1 and 3 year basis. He is absolutely knocking it out of the park. And in fact, I did want to mention that I have both Eric Nuttall and Paul Wong in Ottawa here together at the end of the month to speak to advisors. So if any listener out there wants to let their advisor know what the Sprott energy and gold is all about, I suggest they get a hold of me at sprott.com or toll free at 1-866-299-9906, and we can get them registered at our investment advisor event at the end of the month.
Thanks, Matt. That was a great update, and we will talk to you again same time next week, and have fun.
Sure, John. Cheers.
We will go to the news now. When we come back, my interview with Paul Wong, who is the manager of the Sprott Gold and Precious Minerals Fund. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
It is a real pleasure to have Paul Wong, who is the manager of the Sprott Gold and Precious Minerals Fund and also the Sprott Hedge Fund, with us today on Money Talk. How are you, Paul?
Oh, I'm good, John. How are you?
I'm okay, because being a long-standing gold bug, it is certainly good after the 5-year brutal bear market to have a gold and silver market that seems to have pretty good legs.
Yes, definitely, John. Things are progressing quite nicely in the precious metals area.
Well, the last time we talked, your fund was well up on the year, and I guess where I'd like to start is you last week sent out a memorandum itemizing the reasons why we have a gold bull market on our hands.
So Brexit happened. Obviously, the vote was to leave, and so there's a number of indicators we track all the time. They have quite meaningful impact on precious metals, and so I sent out a note last week in our commentary, and these are sort of the highlights we touched on. One was the 5-year TIPS yield. That's our primary indicator, and right now we're seeing the 5-year TIPS yield testing the lows right now. It broke through it earlier this week. We're still likely to head down from there. So this is predominantly very gold bullish. Second one would be the 10-year government bond yields everywhere around the world. So we're just seeing rates heading to new negative territory. German 10 years broke down to about minus 19 basis points right now. Japan, I think, was around minus 25 basis points. The real eye-opener for us was the Swiss bond yields. The 30-year went negative, as did the 50-year, which is incredible. So virtually the entire Swiss bond curve is now negative. All that is very bullish for gold. So earlier in the year, I think the high point was there's roughly about a 75% probability there would be another Fed rate hike in 2016. That's virtually off the table now. So the probability is somewhere around 0% for July, 0% for September. The U.S. election, so chances are the Fed will not act during the election period. So the earliest would be December, and right now that probability is sitting about 10%. It's virtually, there's almost no chance that there be a rate hike this year. And, coming into 2016 and through the first early parts of 2016, one of the most significant negative potential for gold bullion was that of a rate hike, and that's now gone. Other things we're looking at credit default swaps in the European financials. So that's for the listeners, that's really it's a measure of credit risk for the European financials, and they're widening, they're getting higher. Still well below the January, February highs, but they are widening and they're trending higher. So again, that's gold bullish. We're also watching the yen. The yen strengthens. It's a measure of a risk off or flight to safety type flow. So we're definitely seeing the yen strengthen today. It's testing the 100 level right now. It's a very key level on the yen there. Currency volatility, we're seeing the pound continue to make new lows. Virtually right now, the pound is almost in free fall. Seeing a lot of movements in currencies around the world. So currency volatilities are very, very high. And again, that's a very important gold indicator for us as well. Everyone does tend to focus on the U.S. dollar, but long-standing long-term correlation is that when the U.S. dollar is strong, gold tends to be weak. But there are periods in time when gold and the U.S. dollar actually do move together. One of those periods right now. So if you look at the 30-day correlation between the U.S. dollar and gold, it's actually at one of the highest levels it's been in the last 10 years or so. And the reason is quite simple. It is another flight to safety type trade. So one of the things driving gold right now is a flight to safety, whether the flows are coming from European and international holders. That's probably where more of the bulk of the flows are. We talked about ETF gold holdings, which is a significant buyer of gold bullion. And right now the holdings are rising at its quickest pace since 2005. So there's a massive flow back to gold bullion. We talk about dollar basis swap, which is, again, for listeners, it's a measure of liquidity. And right now they're widening, meaning liquidity is getting harder and harder to come by, so there's more stress in the system. And again, that's gold bullish. And probably one that, from an equity perspective, probably very meaningful. Gold bullion, measured in euros, is broken out of a significant bullish pattern. Post-Brexit, we're seeing a lot of European fund managers buying gold. So they're buying gold on their side of the world. So London-listed, South African-listed names. They've had, tremendous moves. They outperformed the North American comps considerably in the last week or so since Brexit. We see huge volumes coming through. So a lot of the European fund buyers that were ignoring gold bullion and gold equities are now coming back to gold. So that's kind of the quick highlight of what we're seeing. Those are all very significant indicators, and virtually every one of them is pointing in a positive direction for gold.
And what would be the weighting silver versus gold in your portfolio?
Right now, the silver is about a little bit over 20% of the portfolio.
And could you explain for our listeners the gold-silver ratio, because you've got some pretty significant numbers.
Right. So if you look at gold divided by the price of silver, and if you go back 40 years, it tends to trade in a range of 80 times, like how many ounces of silver you can buy for every ounce of gold, that'd be 80 times, and the low would be 40. So recently we were trading in the 80 range, and that's the high end of the range, and now that it's starting to move. And we kind of expect, if you look at the full 40-year history, it tends to oscillate between the 2 points. It doesn't really stop one way or the other. It's either trending strongly down or trending strongly up. So when you see the ratio compress, that means that for every ounce of gold, basically it's moving in favor of silver as the ratio goes lower. So as the ratio heads lower today, it's very positive for silver. So you can pick up a lot more leverage with silver in a bull market move. So historically, if you look at silver, you can pick up about 1.3 times the move on silver versus gold. And that's virtually for almost any time period. The actual number is like 1.3 plus or minus 0.1. Whether you use a 5-year, 10-year, 20-year, whatever, it doesn't matter. You do pick up a lot of extra leverage and extra beta through silver.
Is it fair to say that during the past 5 years, some of these shares, meaning the gold and silver shares, came down as much as 90%, and they, in the last 9 months, are probably up about 100% or more in value. So that still puts a lot of these situations down 80%. So people look at the moves that have taken place and say, this is time to take a profit, but this market looks like it can run a lot further on the upside.
Yes, I call that what you just described, a fun with math exercise. Again, it's just the way the math works. So, when you drop to that degree, and any small movement off of a very, very low base, has huge percentage numbers. So what you need to do is you need to see, the full price range of the movement and figure where you are there from there. Right now, on a full, complete cycle, you're about, at the most, 1/3 of the way through in a full bull market cycle. So there's still room for upside. And that's assuming a normal cycle. So we have long-term databases going back to 1970. In 45 years, we measured 7 complete gold bull market cycles. On average, the bull market cycle tends to last about 3.6 years. And on average, it tends to go up about 360%. So even if we were average, so we're about a third away there. So we're up about year to date. We're up about just a little bit over 100%. So most you can say is we're up a third. But every indication that we see today in the macro environment where the central banks are taking interest rates, i.e. the negative territory, where we're seeing real rates going, this has all the markings, of extraordinary, beyond average bull markets. So we think there's still a lot of upside left in the gold space, the gold and the precious metals area. And if you want extra leverage, come back to silver. It's a great choice.
And we have the backdrop of a competitive devaluation currency environment, which is now really beginning to take hold, particularly after Brexit.
Yes. Another way of looking at it is, negative interest rates is just another form of competitive currency devaluation. We're seeing, I guess China was, headline news back in August of 2015, headline news in January of 2016, earlier this year. But a lot of people don't realize is that the yuan has been devalued significantly during the Brexit event. It's just one of those things where, everyone's focused on one part of the world. Everyone's getting lost in what's going on with the yuan. And it's actually devaluing at a very quick pace. The pace is actually equivalent to what we saw earlier in January this year. And when that happened, it actually triggered a severe sell-off in the global markets. Today, I don't think hardly anyone even notices it. It will have an impact.
And they've got the latitude for further devaluation because it's gone up a lot in the past 10 years. And yes. I was recently in Shanghai for 10 days, and there seems to be a new appetite for not only gold, but silver, and Chinese buying is quite considerable as a way to get money not just out of the country, but into something tangible that's better than paper.
Right. We're seeing that effect virtually everywhere. When you think about it, there probably isn't a single country on the planet that wants a strong currency. That's the nature of the world right now. There is absolutely no country on the planet that wants a strong currency. It's a country you just don't want to do that because there is a competitive advantage for you to devalue your currency. This issue is the savers now. So if you're a saver in the country, you had a choice between owning your own local currency or gold bullion, you're better off. We have data going back 40 odd years or so, and the vast majority of time, gold on any lengthy time period, gold outperforms any local currency. It's just a question of degree.
Now, I date myself because I go back 50 years in this business, so I did go through the 1970 cycle, and gold started at $40 an ounce and ended in 1980 at $850 U.S. an ounce. And when you look at the fundamentals, that is the U.S.'s balance sheet and the condition of a lot of the central banks, it was much stronger in that era. And there seems to be ample reason for this move to continue, and I'm just reiterating the point that we now seem to be in a bull market.
Yeah, definitely. There's ample move further upside. And just to reference it, even going back 10 years, if you track a basket of the 9 major currencies, gold on average has outperformed the basket in the last 10 years. And this is the end of 2015, about 115%. And this year, I think the number is another 25%. So tack that on. You're probably looking at something in the 135 to 140% range now. It is that significant. People tend to forget is that there is a global, worldwide currency devaluation going on.
And I'm looking at the performance for your gold and precious minerals fund year to date, and it's up about 107 108%. And I should mention at this point that anyone who is interested should talk to their investment advisor and make sure that a holding suits their objectives and that they can sleep at night. But certainly the gains that have been achieved have compensated for losses in other areas during the year.
Agreed. It's, gold, again, it's one of the very rare asset classes that offers a non-correlated return to the other asset classes. That's one of the key attractions of gold. When you get the timing right, which we think the timing is good, is very good near the beginning of a new upcycle. Not only do you get the advantage of a non-correlated return, but you get substantial outperformance as well. So from that perspective, it is a unique investment, and it should definitely be considered.
Well, Paul, as always, that's been really enlightening, and thanks so much for joining us today on Money Talk, and we'll look forward to talking to you again soon, and have a great weekend.
Thank you, John. Have a good one, too. It was a pleasure talking to you.
Stay with us, folks. After the break, we come back with David Prince, who is the founder and president of Harbinger Capital Markets Research, in conversation with Andrew Bell of our affiliate BNN. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
It was a tale of two divergent jobs reports this morning. The Americans unexpectedly added more than 250,000 jobs, but Canada surprised with net job losses. For more American economies, we're joined by Harbinger's David Prince. Always great to see you, David.
No, nice to be here again.
So you're famous for your charts. You have a loonie chart for us.
I do.
And what story is that telling?
And it's a loonie of the dollar as opposed to a loonie chart. Yes, it's a very interesting one, because as you can see, that what's happened is we've lost some of the gains that we made after the big rally in oil. We are somewhat following the oil price in terms of the fact that it's come down here more recently in line with the dollar, but there's also this difference in what the perception is of our economic growth versus that of the United States. So today, of course, we got a whole bunch of new data that everybody can scale over for the next 4 weeks to figure out what the next move's going to be. But my take on this whole thing is, first and foremost, that we had a revision down in the States for last month. We had this big move upwards this current round. And when you analyze the numbers, there's so much data that's inconsistent that you go and realize that if we're dependent upon the data coming from the employment report, no wonder policy has been so wrong. It's ridiculous, because what happened was they had this huge increase in educational services in June. Well, of course, in the States. And we had this nonsense of what they were trying to do was all these adjustments. Now, anybody that's done any economic modeling will tell you that all these adjustments continually have to be dynamic because they're constantly changing. And last month we had a big factor called the weather. And that really screwed up an awful lot of the taking in the weather areas such as West Virginia and, of course, Texas. And, of course, we had big problems with fires out in the California. So to go and say that, man, this was such a spectacular growth, you could easily see a revision down dramatically again next month. That aside, what's going on in the United States? Well, what's going on in the United States and all over the world is this dramatic decline in rates, as central banks have absolutely panicked, and now we've got this post-Brexit panic.
Because we had American bond yields falling to the lowest ever this week. Yeah.
At a time when you got, obviously, we had a new record with the S&P. So what does that tell you? That tells you that money is being poured into the United States at a rate that's ridiculous.
Into U.S. bonds.
And anything. Just get out of where they were. So if we look at it from the standpoint of international, we're seeing this ridiculously low level of rates. The questions that should be asked is at a time of new record lows in the States and new record lows for Canada. Here we are, 10-year yields are now below 1%.
I think we have a chart telling that story, showing both countries' yields. Look at that. I mean, it's surreal, isn't it?
It's so unfamiliar with anybody that's been in the market that you shake your head, because the reality is, who's taking that risk on? And it's normally traders, because you cannot believe that a normal investor would be very content to get a 0.95% for 10-year return. It's ridiculous.
In some ways, it's because they want to hold an asset that if there is deflation will go up in value?
Well, it's more to get the assets out of a weak currency to get it into a strong currency, and we'll take anything because we think currency risk is too high. Well, all right. Let's talk about what happens to currencies. And what the big thing that I said to viewers and to my clients was, quite simply, when we get the Brexit vote, we're going to have a lot of volatility around currencies because that's where the big bets are. Mm-hmm. Well, as we found out, the big bets were that, of course, Britain was going to stay. And much to the chagrin of an awful lot of investors.
So Britain's going to leave.
Now we've got to leave. And that was not bet into that the pre-election. But now we see what really was going on behind the scenes, and that is this massive devaluation of the Chinese currency. Nobody's been talking about it.
No, and it's kind of happening on the sly.
The only people that seem to be watching it are the Republicans and a few traders. But the point is, this is a dramatic reversal. And what you're seeing here in terms of that, the higher that number goes, it means it takes more Chinese renminbi or yuan to buy a U.S. dollar. That's weakness. Mm-hmm. And so what you're seeing is this very neat correlation that, of course, helps explain some of the buying that's gone into gold. So we've got this big buying of hard assets.
Right, because with the Chinese in the past, apparently, when they've devalued their currency, they've seen massive capital flight. People saying, well, if the currency's going down, I'm getting out of the yuan.
And that is the big issue that we all have to be aware of. Is this contraction because they need to spur their economy? Are we seeing this big slowdown that people have been fearful about? Or are we seeing the Chinese trying to exert themselves to make sure they don't get any more capital flight going out? I think it's a combination of all. I think that there's a really dire strait economy that's going on in China, and I think that that's going to feed back into certain commodities, pricing, that for sure. But I also think that what you're going to see is much like what people used to say about Britain, there's no way that the UK, British, London homes are going to go down in value. Well, this week was the big other side of that story. We had a lot of those property guys having to close redemptions. Because what's happening is there's a big discount that's going on in the price of homes. So you can't ever say it's up forever. But I do I want to pay attention to this yuan weakness because that would definitely tell me there's going to be fewer dollars coming into Canada.
It's been an exciting tennis weekend, and tomorrow morning markets open and we're back to the battle for investment survival. Thanks so much for joining us on Money Talk. We'll be back at 2 p.m. next Sunday. Have a great week. You are listening to 580